This is going to be part 6 of our lectures on statement of cash flow, and in this very lecture of mine I have come up with a very specific agenda of telling you how to deal with some specific technical items while preparing statement of cash flow. So some students they report with this problem that, sir, how to deal with the bonus shares when they are issued out of surplus, how to treat them in our statement of cash flow. When there is a redemption of preference shares at premium or par or at discount, how to deal with that redemption of preference share in statement of cash flow. There is another point, that how to deal with interim dividend and final dividend, which I have already discussed in previous questions as well. Sometimes we come across a problem of assets overvaluation. There is an overvaluation of asset. How to deal with that overvaluation situation while preparing statement of cash flow. And lastly, sometimes we are reported with a bank balance with bank overdraft. That in your balance sheet you are provided both the values. On one hand you have a bank balance on the asset side, and on the other you have bank overdraft on the liability side. So this is, these sets of problems, make a question very unique. So I thought of coming up with a question which includes all of them. So in one question, I would be telling you how to deal with all these situations in a single question. But before proceeding to the question and solving it, let me talk about the bank balance with the bank overdraft. That needs some clarity, that needs some explanation here. And what is that explanation? Why this explanation is needed? Let me first clarify. The explanation is needed because sometimes while dealing with the bank balance, what students do, they calculate cash flow from operating activities, investing activities and financing activities. After aggregating all three values, whether it is cash generated or cash used, they end up with the net increase or decrease in cash. And eventually what they do, they add opening balance of that bank and cash and cash equivalents, and they are supposed to get in an obvious manner the closing balance of cash and cash equivalents. And here comes the problem. After solving the entire question, you are ending up with this situation where your balance doesn't tally, or the question refused to tally, question refused to tally with the answer, your answer is not getting tallied. So this is a situation where you get which makes you little nervous, and if it is happening in the examination, it actually disturbs your entire calculation process, and you start searching in the question or in your solution how to fix it. So do remember, whenever you come across this kind of situation, before going to any other point, first search from the question on the liability side, is there any bank overdraft given? And if it is so, your bank balance need to be adjusted with bank overdraft. So I am telling you from the point of view of dealing with this situation in examination, that whenever you come across this situation where your answer refused to tally, you should first have a look at the liability side. Is there any bank overdraft? If it is so, your bank balance need to be reduced by that value. Why so? I am giving you an example. Suppose I am having in my bank account 10 lakh rupees. My bank balance is 10 lakh rupees. And there is a bank overdraft of rupees 2 lakh. Which means I have already withdrawn additional 2 lakh rupees from my bank, which is yet to be settled. So if I go to the banker and say that I have a balance of 10 lakh rupees, as per my passbook, banker will say, no, you are having a net balance of rupees 8 lakh only. Because 2 lakh rupees have already been withdrawn by you, and if you want additional bank overdraft, then there is no problem. You can issue checks for the additional value also, but that will actually be counted into the bank overdraft. So the objective behind taking up all these items in one question is just to make you understand how to deal with these important points. So I shall be telling you one by one how to deal with bonus shares, how to deal with the preference shares redemption, how to deal with interim and final dividend, and then how to treat this overvaluation of asset. But for that we need to go to this question. So let's move on to the question. From the following balance sheet of a company as on 31st December 2013 and 14, you are required to prepare a statement of cash flow. So there is a company which is providing you the balance sheet of 2 consecutive periods, and it is asking you to prepare a statement of cash flow. If you look at this balance sheet, again it is also in the T-shaped format, equity and liability for 2013 and 14. Here the movement is from left to right. First of all, we are provided with the value of 2013, and then subsequent year, that is 2014. On the asset side also you have 2013 and 14. On the liability side, we have equity share capital, we have 10% preference share capital, we have reserve for replacement of machinery. See, this is a new item which we have come across. So you can have numerous items of this kind, need not to get disturbed with that. You have to simply understand what is the impact of it. If there is a reserve for replacement of machinery account, obviously from where it will get money? From profit and loss account. So it will result into some allocation of funds from profit and loss account. So from 15,000 to 20,000 it has become, which means there might have been some allocation from profit and loss account. That is rupees 5,000. Long term loans, there was no loan earlier in 2013. In 2014 you have got a loan of rupees 40,000. Bank OD is again here. It was earlier there and now it is not present. In 2014 it has become 0. Trade creditors we have, profit and loss account we have. On the asset side we have all other items just like previous question, and we have bank balance of 11,750 in 2013, and now in 2014 it has become 32,000 rupees. So this is the balance sheet which is provided to us for preparation of statement of cash flow. Let's move on to the additional information. The first additional information is, during the year, additional equity capital of rupees 25,000 was issued by the way of fully paid up bonus shares. Now here you need to know what is the treatment of bonus share, how the bonus shares are issued. Bonus shares are normally issued when a company is not in a position to pay bonus in terms of cash. Or you can say company is running short of cash, you have to pay bonus to your equity shareholders, and at that point of time, or you can say to your employees, you are issuing bonus shares. So how to issue if you don't have any cash profit? So it's better to issue equity shares to them. So the objective is here to first accommodate the issue of bonus shares, and along with that you can increase your equity capital also. So what company does, it transfer the value of say in this question 25,000 rupees must have been transferred from profit and loss account to bonus to shareholders account, and from bonus to shareholders account it must have been transferred to share capital account. So you can say in a way it is a capitalization of your profit. So without any payment you are actually making payment of bonus. So I'll tell you how to deal with this bonus shares. Final dividend on preference shares and an interim dividend of rupees 4,000 on equity shares were paid on 31st December 2014. So both the dividends, one is on preference shares as final dividend and interim dividend on equity shares have been paid. Proposed dividend for the year 2013 were paid in July 2014. Remember, here it is mentioned, but even if it could not have been mentioned in this question, then too we must have been showing it as a cash outflow, because whatever has been proposed is supposed to be paid. So if question mentions that there is a proposed dividend, we have an inherent assumption, unless otherwise mentioned, that proposed dividend must have been paid in the current year. Next is, during the year, one item of plant was overvalued by rupees 3,000 and credit for this was taken in the profit and loss account. Now the second line, the subsequent line is more important. You have overvalued a particular item of plant to the extent of rupees 3,000. Now overvaluation may impact what? The amount of your depreciation. If there is an overvaluation, there can be an overcharging of depreciation from profit and loss account. But here what question is saying, that the credit for this item was taken in profit and loss account, which means you might have inflated your profit to the extent of rupees 3,000. So whatever error you have committed, that error need to be rectified by nullifying its impact. So this 3,000 shall be subtracted from your profit. Fixed assets costing rupees 6,000, where accumulated depreciation is rupees 4,800, they were sold at rupees 250. So if I find the real value or WDV of this asset, 6,000 minus 4,800 becomes 1,200. So the asset of rupees 1,200, they were sold at rupees 250, which means there is a loss of rupees 950, and question itself is saying loss arising therefrom was written off. So it means you have written off that loss from profit and loss account. Again, it is a non-operating item, so that need to be nullified. Preference shares redeemed in the year 2014, they were paid out of a fresh issue of equity shares. So you have redeemed preference shares by the way of paid out of a fresh issue of equity shares. Some students, they by mistake misunderstand this point. They feel that via issue of they feel that this preference share might have been a convertible preference shares and they are converted into equity shares. But here, if you assume so, you must be committing a mistake. Read this line carefully. Preference shares redeemed in the year 2014 were paid out of a fresh issue of equity shares, which means whatever money you have received, you have collected by the fresh issue of equity shares, that money, that cash have been used for redemption of preference shares. On the contrary, what students assume? Normally they feel that it might have been a convertible preference shares, so it could have been converted into equity shares. But that is a wrong perception, right? Premium paid on redemption was 10%, which means on redemption value there is a payment of 10% of premium. So we shall calculate that premium also. So just like previous question, we'll start our solution. This was all about the question. Now we shall move on to the solution part. Starting with the working note. So I have opened equity share capital account. Opening balance was 1,20,000 and the opening balance was 75,000 and closing balance is rupees 1,20,000. And for bonus shares, obviously this could have been added to your equity share capital. So by profit and loss account, for bonus 25,000 rupees might have been added to share capital, and remaining is what? Remaining is the fresh issue. So we find the balancing figure of rupees 20,000. So this 20,000 rupees is nothing but your inflow under the head of financing activity as a balancing figure. Now some students, what they do, they write opening balance, they write closing balance, but they forget to charge bonus equity from this equity share capital account. Do remember that the amount of profit which have been apportioned from profit and loss account for bonus, for facilitating that bonus issue, definitely must have been transferred to equity share capital. And I told you the journal entry that it must have been profit and loss account debit to bonus to shareholders account and bonus to shareholders debit to equity share capital account. If we make a compound entry, the bonus to shareholders account is getting eliminated and we find an entry of profit and loss account debit to equity share capital account. So this 25,000 rupees of bonus equity should have been credited to the profit and equity share capital account, and that is what we have done. So the fresh issue, or you can say the cash from fresh issue is rupees 20,000, which we have received here. Moving on to the fixed assets account, we have shown opening balance, closing balance, and here, just like the previous question which we have discussed in the previous lecture, accumulated depreciation for that asset which have been sold out, that is 4,800, have been credited to fixed assets account. And the cash amount, the bank amount, that is 250 rupees, which you have received out of sale of this fixed assets, have also been shown. Loss on sale is actually credited to fixed assets, so we have shown it here. And the overvaluation of asset which was done, it has to be debited to this account, to profit and loss account, 3,000 rupees, and balancing figure will give us the value of the payment, that is you must have purchased fixed assets to the extent of 16,660. So this is the way we have to treat with this fixed asset account. It becomes a little technical cause of two things. There are 2-3 things present here. One is overvaluation of asset, so that have been transferred to profit and loss account. So fixed assets account debit to profit and loss account. So asset might have been increased and the balance might have been transferred to profit and loss account. So we are not doing anything new. Whatever has been reported in the question, we have simply executed it here, placed it in the fixed assets account. On the other hand, on the credit side, we have shown the sale of this fixed assets, bank account debit 250, profit and loss account debit 950, and the closing balance is given in the question. So we find the credit side to be higher than that of debit side. So difference must have been the purchase of fixed assets. If it could have been opposite, then obviously we could have said that there must have been a further sale of fixed assets. Moving on to accumulated depreciation account, here the treatment is same, just like in the previous lecture I have discussed. We have to show fixed assets account, we have to reduce that depreciation, we have to credit fixed assets account by that depreciation, by that amount of depreciation which have been accumulated on that asset which have been sold out, and here it is 4,800. Opening balance and closing balance have been shown, and balancing figure is indicating that this is the money we might have taken from profit and loss account, which is 13,260. So this is the way we prepare this accumulated depreciation account. Now we shall move on to the statement of profit and loss account. We have to nullify the impact of non-operating and non-cash item. So we have taken the value from profit and loss account of current year, that is 2014, which comes to be 1,02,700. And now we'll nullify the impact of non-operating items first. So what are those non-operating items? First was proposed dividend, second was interim dividend, third was preference dividend, and fourth was bonus issue. All four, they belong to which category, which activity? They belong to financing activity. Another transfer, which was a non-cash transfer, it was reserved for replacement of machinery of rupees 5,000, that has also been nullified. We have added it back. After making this nullification of non-operating and non-cash items, we have found the profit after adjustment, that is rupees 1,70,700. And we have the opening balance also. So opening balance of profit was 1,03,350. The difference will give me net profit before tax. So what we have done here, we have actually taken these non-operating and non-cash items to arrive at the profit before tax. Alternatively, what you can do is you can take up the difference of the opening and closing balance and straight away show all these entries in your statement of cash flow. So to avoid huge number of transactions into your statement of cash flow, to make it in a summarized form, what I have done, I have shown this, I have prepared this statement of profit and loss in our working note. Now after this, we are all set to prepare statement of cash flow for the period ending 31st December 2014. What we'll do here, we'll start up with the net profit before tax, which we have just arrived in our working note, 70,350. Now here comes the role of non-cash, non-operating items, which are the part of profit and loss account. So what we have done here, we have taken premium on redemption of preference shares, which you have redeemed rupees 2,000, because that premium must have been subtracted from profit and loss account. It must have been charged from profit and loss account. In absence of any other information, we assume that it must have been a transfer from profit and loss account. Otherwise, if you have studied corporate accounting, you all know that premium on redemption of preference shares, either it can be taken from profit and loss account, or it can be taken from that security premium account, or it can be taken from general reserve also. But here we have assumed that it must have been taken from profit and loss account. And this is actually 10% of your amount of preference share of rupees 20,000. So 10% becomes 2,000. This is my premium on redemption. Depreciation being non-cash item, 13,260. We have calculated it. We have taken it from accumulated depreciation account, which we have prepared in the working note. Loss on sale of fixed assets, again it need to be added back to the profit, because this is an item which belongs to investing activity, not the operating one. So we have added back this 950 rupees of loss on sale of fixed assets. And there was an overvaluation of plant, so profit on overvaluation of plant must have increased our profit. So we have to reduce it, we have to nullify the impact. So profit on overvaluation of plant have been subtracted to the extent of 3,000, and now we have got operating profit before working capital changes. So my dear learners, what I have done into this cash flow from operating activities, I have nullified the impact of non-cash, non-operating items. Even these items could have gone to the working note, but why it was not done there? Because we have to show depreciation, we have to show premium on redemption of preference shares. Since the list of item was very long, that is why deliberately we did this calculation, partial calculation in the working note, and partially it has been shown here. So choice is always open to you. You can either do all the calculations here, or you can do all calculations there also, or you can mix and match like I have done. You can show some items there, like non-operating items you can show there, and non-cash items you can take up in the question. After this, once we have got operating profit before working capital changes, we have to make adjustment for change in the value of current asset and current liability. And there is no change in the method, just like we have done in the previous questions. If there is a decrease in your current asset, what we have to do, you all know. If there is a decrease in current asset, it will result into the inflow. If there is an increase in current asset, it will result into outflow. So increase in stock of rupees 60,000 have been subtracted. Decrease in creditors, decrease in liability, which means you must have paid this money to them, that have also been subtracted here. So decrease in creditors have been subtracted, increase in stock have been subtracted, but decrease in debtors means If there is a decline in the value of debtors, it means we must have received some money from debtors, so that have been added. So we have to monitor each and every item of current asset and current liability, except on the liability side provision for taxation, and on the asset side you have to ignore cash and bank balances, because we are using it separately. We are doing the calculation, we are considering it at some other place which you're already aware of. So operating profit after working capital changes comes to be 71,660. And in this question, by chance there is no mention of income tax payment. So if there is no mention, we will not show any value. We have shown income tax paid to be nil, and here, since the value is positive, we can write that it is net cash generated from operating activities, which comes to be 71,660. So this is my net cash generated from operating activity. So in this way we have calculated, we have completed the first segment of our statement of cash flow, that is resulting into net cash generated from operating activities. Now we shall move on to cash flows from investing activity. Under this category, from the fixed assets account, we have got sale of fixed assets to the extent of rupees 250. So there is a sale of fixed assets by 250 rupees. We have shown it as a cash inflow. Purchase of investment was made to the extent of 25,000 rupees, so it has been shown as a cash outflow. That is why the value is given in bracket. Purchase of fixed assets we have already computed while preparing the fixed assets account. We have found in the working note 16,660. So if we look at the total value of net cash from investing activity, we find that the outflow is greater than that of inflow. So both the items, out of 3 items, 2 items of 25,000 and 16,660, they belong to which category? They belong to outflow category, whereas inflow of rupees 250 is there. So resultantly we can say that there is a net cash used in financing activity to the extent of 41,410. So from this activity there is no generation of cash, rather there is a usage of cash. So we have reported it in negative, that net cash used in investing activities 41,410. Now after completing this activity, we are left with the last activity, that is cash flows from financing activity, which means the liability side of your balance sheet, that too which belongs to long term liability. And we have witnessed that there was an issue of equity shares to the extent of 20,000 rupees. So this 20,000 rupees is being posted as cash inflow under the head of cash flows from financing activities. There was a redemption of preference shares. Remember that redemption of preference shares shall result into the cash outflow. Amount was 20,000 and there was a premium of 10% on that. So 22,000 rupees have been shown as cash outflow under the head of financing activity. That is why the value is put in bracket to show that it is negative value of rupees 22,000. Interim dividend paid, that is also an outflow item, so we have shown it as a cash outflow 4,000 rupees. Final dividend on preference shares, do remember that whatever is the value of preference share reported, the book value of preference share reported in the balance sheet, we have to calculate the percentage on that. In this question the percentage and value both were given, and that comes to be rupees 10,000. Final dividend on equity shares 12,000 rupees. It is basically the proposed dividend of previous year which we have paid in the current year. And lastly we have long term loan raised, because previously there was no long term loan, so company must have issued rupees 40,000 as long term loan, which is resulting into the cash inflow under the head of financing activity. After aggregating all these inflows and outflows, we have found that there is a net cash generation from financing activity to the extent of rupees 12,000. So this is actually resulting into the net cash generation from financing activity. Now it's time for us to aggregate all 3 activities, cash flow from all 3 activities, and we observe that from cash flow from operating activities there is a positive cash inflow of 71,660. Under investing activity there is a cash outflow, or you can say cash used, is 41,410, and under financing activity there is a generation of cash to the extent of rupees 12,000, resulting into the total net increase of rupees 42,250. And here what we'll do, we'll add cash and cash equivalent in the beginning. And as I told you, what you have to do, you have to take up the bank balance which is given in the balance sheet on the asset side and subtract bank OD out of it, and that has given us a negative value here, that is 10,250. After adding it, we have got cash and cash equivalents at the end, that is rupees 32,000. So my dear learners, in this way I have tried to make you understand how to deal with a question where you have multiple unique kind of problems like bonus issue, like you have bank OD, and along with that you have a bank balance, you have interim dividend, you have final dividend, you have some overvaluation of assets. And I hope you must have understood and enjoyed today's lecture of mine. And with this, I am ending the topic of statement of cash flows. Very soon we'll be coming up with some other topics as well. Thank you so much.